Today, we're looking at some alternative data and whether it shows that unemployment is about to rear its ugly head. And then for today's Trading Takeout, we're going to focus on why momentum is your friend, because I think loads of people seem to neglect the concept of momentum. They try and pick reversals, but we're going to see exactly why you should just focus on going with that Momo. Before we get into it though, make sure you like this video and subscribe to the channel if you want me to pop up in your YouTube feed every single day, giving you the best market commentary to maintain your trading edge. So I'm going to need you to really focus on this chart, and it's a bit of an alternative data set, but it's far more real time than the official data sets from the ONS, from the Bureau of Labour Statistics, etc., etc. And what this is showing is that the search term for redundancy is way, way higher than in just the last couple of years. So it's way higher than 2023 and way higher, especially versus 2022. You can see the average here. So the average for this year, which is literally only a month, but it's quite considerable and quite important, is you know, at 100 based on the index. For 2023, it's about, you know, 20% less, say. And then for 2022, it's about half as much. This is quite concerning. And there's an interesting thing that I've been doing recently to try and understand this, because I'm slightly distrusting of unemployment statistics. For example, in the UK, there has been a massive increase of long-term disability benefits, which means that people are coming out of the workforce. And this is contained amongst working age people. If you're on disability benefits, then you're classed as not being eligible to work, so you're excluded from the unemployment statistics. But this is being added to by about 20 to say 40,000 people a month. And that is considerable. That's a considerable amount of working age people not being in the employment, I guess. Now, if we are considering an uptick in unemployment, then we're looking at redundancy as the main and fastest way for people to be unemployed to lead to that increase in the unemployment metric, right? These are going to be people who are currently in jobs who are going to need another job. So they would be classed as unemployed if they're made redundant. We're seeing a ton of firms now, you know, do job cuts and get rid of people, whether it's a layoff or whether it's redundancy. There are differences, you know, earlier staff won't get any kind of redundancy and that kind of thing. But if you go onto TikTok now for, you know, as a trend, there is a trend of people recording themselves being made redundant. It's quite staggering, actually, and it's quite terrifying. But companies like SAP, companies like Microsoft, you know, all of the banks, a hell of a lot of places are making rather large job cuts. And interestingly, I saw a TikTok just yesterday of a plasterer in the UK who said he hasn't had a call for work since the start of December. This is very interesting because if you look at the amount of companies in trouble in the UK, there's about 47,000, but most of them are in the construction sector. Now, what does this mean? Well, most people in construction are self-employed. That's why they own limited companies. Okay. The construction sector is a massive bellwether for the UK because a hell of a lot of the UK GDP is dependent on housing, construction, real estate, etc., etc. If these guys are being shown to sort of be in trouble, if they're not getting work, if they're not able to do all of this, then that means that the economy at large is also in trouble because construction is a bellwether for the UK economy. Does that make sense? So the way in which we are focused on this now should be, okay, how does this influence rate cuts? If unemployment does tick up considerably, and if the Bank of England, the Fed starts concerning themselves explicitly with the unemployment metric, then what we're going to note is that those rate cuts are going to be brought forward drastically. Then what we have to start deciphering, especially in the FX world, is to what extent are yields narrowing or widening? Okay. For example, if the UK 10-year gilt yield were to versus the US yield were to widen by say 50 basis points, okay, that would probably mean in favor of the UK yield, that would mean that cable rallies. Okay, it's unlikely to happen. It's likely that the Bank of England are going to cut first. So we would have to be very, very sensitive now to the unemployment that is ticking up in the data, and it's better to get real-time data to be prepared for this. Have a play with Google Trends. See if you can spot reasons to sort of jump ahead of certain themes. You might search for redundancy. You might search for something more specific. I don't know. Unemployment benefits, even how to get unemployment benefits, these kind of search terms, and start really, really thinking about how people behave, how people's behavior then might influence a trade, a theme, or just an idea. I think it's really, really important just to keep your brain juicing over as well, and to try and understand and see if there is any edge in some of these things that you're doing. It's fantastic practice, and it helps you understand the economy better anyway, even if it doesn't lead to a trade idea. Today's trading takeout is why you need to make momentum your best friend. Now, there's quite a nice quote from George Soros about bubbles, and he's, to paraphrase, basically saying that if you spot a bubble, don't try and short it. You want to ride the bubble for as long as possible, because we're traders. We don't necessarily care about the intrinsic value of something. We really, really care as to whether it's going up or down. Okay. A bubble is a fantastic opportunity to get long. You've got so many people at the moment talking about the S&P 500 being at all-time highs, making all-time highs 3 days in a row, and they're like, no, this has got to stop at some point. Why do you care so much? Why do you care about it reversing? Why aren't you involved now? Because clearly it's an irrational market. It's trading. It's trading at the end of the day. We're not investing. We are trading. We do not necessarily care about fair value. We care about momentum and how far something can stretch. Once you see that momentum dying, sure, you can consider it a time to go the other way. But until you see that exact inflection point where a market is looking exhausted, when you've got something else to consider into the picture, whether it's a macro variable, whether it's something else, that's when you stop being long it. Until that point, there is absolutely no point in trying to pick a top. Bubbles are there for buying and never ever for shorting. That's how you get your account basically blown up. So let's try and get rid of this connotation as a bubble being a negative thing. Bubbles are fantastic for traders. It's how many make money very, very quickly. So make momentum your best friend. Forget the doomsayers, forget the bubbleologists, because they tend to be wrong.